Hi, this is Kyle Green from Mortgage Alliance. I'm here to talk to you today about why rates move. I often get asked, why is my variable rate moving up or down, or why is my fixed rate moving up or down? The first thing what you want to know is that they do move independently of each other. So if the fixed rates are rising, it's not necessarily going to be, or you're not necessarily going to see that variable rates will also rise. So I'm going to explain a little bit about the differences between the two and how they move. The first is fixed rates. Now, fixed rates are dependent on bond yields and bond rates and stock markets. So typically, in order to determine what a fixed rate may be going for at any given time, you can usually refer back to where bond yields are rising, what the trend is. If you see 5-year bond yields in Canada dropping, it's usually going to mean that you also see fixed rates also dropping. If you see bond yields rising, then you'll likely see fixed rates also rise. Usually you can look at about a 1.5% to 2% spread on top of whatever a bond yield is. So if you're looking at a bond yield of 3%, you can bank on a 5-year fixed rate being somewhere between 4.5% and 5%. Now for variable rates, they move a little bit different than a fixed rate does. Variable rates are dependent on the prime rate, and the Bank of Canada sets what's called the overnight lending rate, which affects the bank's prime rates. Now prime rate will move up or down depending on many economic factors like growth, inflation, the dollar, etc. We've just recently seen a 0.25 increase in the Bank of Canada's overnight lending rate, which is affecting the prime rates with the banks moving up from 2.25 to 2.5%. The reason that this increase occurred was because we're in a situation right now where our Canadian dollar had dropped a little bit. And one of the concerns of the Bank of Canada increasing the prime rate was that by increasing prime rates, we actually receive more foreign investment into Canada, which would actually increase our dollar comparative to the US dollar. This would have a severe negative impact on our exports. So as much as you'd think that a good Canadian dollar versus American dollar is usually a good thing, it's good when you're traveling, but it's not necessarily good for those companies that are in manufacturing or in the forestry industries. We also saw the rates move up because inflation was nearing the 2% mark, and that's usually a mark that the Bank of Canada does not want to see us exceed. So you can bank on the Bank of Canada watching this very, very keenly to make sure that we don't go too far above the 2% inflation rate. The reason the rates have been kept so low for so long is because the growth and inflation have both been very, very low in Canada, and our Canadian dollar has been nearly at par or at par with the US dollar for the last 2 years or so. Now, why did the Bank of Canada raise these rates? We're definitely in a position where over time we're going to see that these will slide up, and we're typically going to see, or in a normal or balanced economy, prime will usually sit around a 6% rate. It will eventually likely get up or close to that mark, but how long it will take is really the question that nobody can answer. When the Bank of Canada met on June 1st, 2010 to determine what they're going to do with that prime rate, it seemed like their impression was that they probably would be looking very cautiously at their meetings every 6 weeks to determine whether they really want to start aggressively increasing this or not. Some factors like the European Union with Greece and Spain and whatnot, and those municipalities and countries, I should say, are going into a situation where they may not be able to service their debts. They're definitely going to have a small impact on the Canadian economy as well. But the United States will definitely be keeping their rates low for the remainder of 2010. Whether or not we'll see a slight increase from them is yet to be seen, but unlikely. And if we see that continue, if we are raising our rates, we're going to see our dollar definitely jump above the US dollar by quite a large margin. And in that scenario, we're going to see again some negative impact on our exporting business. So we may see that prime will hit around 2.75 to 3% by the end of this year, or at least that's my prediction. Take it with a grain of salt. I may be as much of an economist as anybody else out there, but I'm also a gambler too, so I'm no better than anybody else taking a guess on the street. But we're expecting that prime will probably be close to the 3% mark by the end of this year. If you have any questions, please contact me at 1-888-531-8890 or email kyle@homelinecanada.com. Thanks.